Hi everyone, this is Jason Barrick of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. I like to have him on every few months. He now has over 2,000 subscribers on his YouTube channel. It's long overdue. He should have had it a while ago. He provides balanced coverage of the gold and silver markets. He's a former Silicon Valley executive and a Wall Street lawyer. He's a follower of the Austrian School of Economics. Louis Cammarosano of Smaulgld, thank you for joining me again.
Jason, thank you for the introduction, and thanks for having me on your show again.
Thanks, Louis. Glad to talk to you about a lot of the interesting topics you cover. I find your insights are very valuable, especially compared to the rest of the gold and silver industry, where it's like basically silver is going to 600 as soon as possible, or a bullion coin is gonna save everyone's butts. But anyways, let's speaking of altcoins and coins, let's talk about your opinion of Bitcoin, Ethereum, and some of these initial coin offerings. You've released some videos on that. Today, Bitcoin had a soft fork. I'm going to pull up the story on CoinDesk real quick and read the headline. Bitcoin Cash just mined its first block, making blockchain split official. So what's your opinion then on Bitcoin? It hasn't crashed like a lot of people actually predicted it would during this hard fork. I remember reading and hearing from experts on Bitcoin that you should sell your Bitcoin, sell your Ethereum, get out of these things, and wait until the soft fork is decided.
Well, I think the biggest advice was not necessarily to get out of them, but to get your coins off the exchange, especially Coinbase, because they signaled early on that they were not going to support Bitcoin Cash. And I don't know what's going to happen, because if Bitcoin Cash has legs and it continues to be worth a couple $100, and you've just been denied that. So what most people did, if they were smart, they removed their coins from Coinbase. They have them in their own wallets. They control the keys, and they'll be making the, they'll be able to pull their Bitcoin Cash out and then sell it or do whatever they're going to do with it. But apparently Coinbase looks like, I don't know what they're going to do, whether they're just going to hold on to the coins themselves and distribute them later, which I think is the only proper legal thing to do, because just because you're not supporting the coin, I know they have something in their terms of use, but to me it doesn't cut the mustard, because there's some value there and you're entitled to it. And so anyway, I think that was the big story, is that Bitcoin Cash may continue, and if you were on Coinbase, you didn't get it.
So Bitcoin Cash is basically like a stock spinoff then, where if you were holding Bitcoin during this soft fork, you're entitled then to another coin of the separate coin, like a stock spinoff?
Well, it's not the same. Yeah, it's more like a stock spinoff than it is a stock split. In a stock split, you basically get the stock goes from 20, you get the same amount. Here you actually get a new coin that's just following the same chain, but now it's split. And so whatever you had in Bitcoin, you get in Bitcoin Cash.
Yeah. Stock spinoffs, you're separating two businesses. So normally, like, a business is spinning off like a different part of the business, or if it's a resource company and they're producing miner, they're spinning off exploration assets into another company, something along those lines. But yeah, as a shareholder, you would get those other things. Spinoffs tend to do pretty well in stocks, but
you remember a spinoff though, Jason, is when you have 100% of a company and it includes the business unit you're going to spin off. You've always owned that, and when you spin it off, it's different than when you split the chain, because you now have two Bitcoin as opposed to two companies. It's similar, but the thing is that it's an entirely new blockchain that you now own value in, whereas you've always owned the value in the spinoff. But I guess you're right, because in the spinoff, that company then gets a chance to go out on its own and see how well it can do, and you get the value. And then it's the same thing happening with Bitcoin Cash. It gets to see what it can do, if the miners support it, if the merchants support it. So I guess it's definitely more akin to a spinoff than a stock split.
Yeah, this is a new frontier with the forks of the coins. We know Ethereum did a hard fork last year. to do that when there was a hack of the Dow coin. You released a video recently about the SEC acting like James Comey, and obviously you know I don't like James Comey. So why do you think the SEC acted this way to not go after
the DOA?
You and I have discussed this off recording, that there's definitely fraud going on in some initial coin offerings. So why do you think they're waiting and seeing and not going after anyone yet?
Well, the reason they're not going after anyone yet, I think, is because they want to control what happens to ICOs. So right now, the current legal structure is, and has been since 1933, that the Securities and Exchange Commission has jurisdiction over securities offerings. And as part of having that jurisdiction, they require companies that are issuing securities to register their securities with the SEC, which involves filing a registration statement and an offering document, a prospectus, whereby they include all the material information that an investor might need to make an informed decision about the security. So what the SEC has been saying, and they're saying that a ICO token, doesn't matter whether you call it a token, if it has the characteristics of a security, then they're going to take jurisdiction over it, which is not telling you anything new. That's been the law since 1933. The issue is that people have been doing ICOs, and some of them have been hiring clever lawyers, and they've been structuring them as such so that they're not securities, that they don't have, that the person who owns a token doesn't have an ownership interest in the country. And they try to make it so that it doesn't fit the definition of security. And if it doesn't fit the definition of security, then the SEC can't step in and say you've done something wrong. So the reason I think the way they acted the way James Comey did, in that they looked at the DOA ICO and they went through how it was structured and what was being offered. And they came to a legal determination, the SEC did, and said this DAO token is a security. Now, under the law, if it is a security, then by definition, under the Securities Act of 1933, that security offering must have been registered. And if you have a security offering and you don't register it and you don't have an available exemption, well, then you violated the law. And the SEC laid out chapter and verse why they thought the way the DOA structured their offering was indeed a securities offering. But then they said, just like James Comey, if you remember James Comey and that famous July 5th press conference when he gave his results of the FBI criminal investigation into Hillary Clinton's mishandling of classified information in the private email server, he basically explained everything she did wrong. And then he said, but, you know, based on what she did, we couldn't prove intent and no reasonable prosecutor would bring a case. He at least gave a reason, to most people not acceptable, why he wasn't going to prosecute what looked like a clear violation of statute. In this case with the DAO, the SEC didn't even give a reason. They just said, considering what we know, we've decided not to bring an action. And then they used the opportunity to say, but we want to caution participants that if you do an ICO, it could be a security depending on the facts and circumstances. And if it is a security, well, you've got to register them. Okay. The problem I have with that, Jason, is that's always been the law. They're just repeating the law. And if they could have issued that statement without going through the DOA structure and without making a determination that the DOA was a security. But here's why they did that. They wanted to have their cake and eat it too. Had they then brought an action and the court said, you know what, maybe that's not a security, well, then all hell would have broken loose, because then the SEC, all other ICOs would be structured just like the DAO to avoid being characterized as security, because if the SEC lost the case, then the SEC could no longer regulate cases like the DAO, and all ICOs would be structured like the DAO. So what they did instead was they decided to use their authority. If anyone knows what a security is, it should be the Securities Exchange Commission. And it probably is the way they described it. They just said, look, we're just going to tell you that one is a security. And therefore, all other companies that are looking to do a ICO just like the DAO are now going to be hesitant because the SEC has deemed that type to be, even though they didn't litigate it, to be a security that requires to be registered. I think what they want eventually is they want exactly the same process that they have for the IPO right now. And the IPO, as you know, is run by Wall Street bankers in Silicon Valley, and they make a fortune. They're the gatekeepers for that whole process. I think what they want in Silicon Valley is now they smell blood in the water. They see all this money there. They want to bring in their lawyers, their teams, their bankers, and do ICOs that are regulated exactly the same way that IPOs are regulated, which means then the way you go public, you don't do an ICO through getting your buddies together, putting a white paper up online, and getting a few YouTube channels to pump it. What you do is you get a banker, you get a venture capitalist who gets a banker, and then you submit and it costs a lot of money to go through this process, and you submit everything with the SEC. Well, once everything starts flowing through the SEC now has jurisdiction, the bankers are involved, the Silicon Valley people are involved, and I think that's what they want. If they were to try to just grab try to stop it right away and say, look, this was wrong, it was a security, it wasn't registered, we're going after them, litigate the case and win, that could have a chilling effect on the whole industry. They don't want the industry to die. They want it to grow so they can corral it and own it. And I think that's why they did it. Now, what Comey did, you can speculate. I'm not saying there's an analogy there, but what the SEC did was very clever. They managed to get their point across by deeming the DAO as a security, but also by warning everybody that don't do what the DAO did. But it's kind of like what Comey did to Clinton. He said, look, if anyone else did this in the future, that's not to say there wouldn't be consequences. And that's exactly what the SEC said is, look, this is a security and you got to be careful. So they repeated the law and they used a real life example rather than just issuing a bulletin saying, hey, by the way, guys, that you're doing these ICOs, remember the securities laws apply. They used a real life example with the DAO.
And there's a lot of money for funding now for initial coin offerings. I believe so far in 2017, funding for initial coin offerings has outpaced venture capital funding now in Silicon Valley. It's over $1 billion in initial coin offering funding so far in 2017. So money has gone there because, you know, surprise, surprise, it's not regulated as much. And there's a lot more creative entrepreneurs willing to go there. You also brought up the lawyers. You know, if you do have some money or there's venture capitalists who can make a lot more extra money, not necessarily going through all the regulatory process and the higher fees. If they hire a good lawyer, there's gray areas that lawyers can make themselves and their clients a lot of money. So before this thing gets fully regulated, there's still a lot of money to be made from the early investors who can, you know, get in on the ground floor, buy their coins on a coin offering at a discount, and then dump their coins at the ICO to the retail public. Who's coming in, who a lot of these guys, retail public, is not doing that good of research. They're only buying things that are going up, or some of them are just buying things indiscriminately and hoping to get rich off of one. But yeah,
absolutely.
The Comey example, I really don't want to talk about this too much because we should do this on a separate show. But I mean, he didn't even mention like all the different laws Hillary Clinton broke. There's a strict liability law with the US Espionage Act that she doesn't have to have any intent. She only has to be grossly negligent with the information, which she didn't even bring up in that speech. That was a slam dunk, you know, guaranteed felony with her gross negligence violation of the US Espionage Act.
And she did it over and over again too.
Yes. So you don't even have to have any intent to sell classified or top secret information to a foreign government or anything like that. You only have to be grossly negligent with that intelligence, and it's a strict liability law. And she obviously, you know, anyone who's not a hardcore Democrat lawyer and loves Hillary Clinton would rationally admit that she violated that law. I mean, I've heard Democrats like H.A. Goodman and other guys who hate Hillary Clinton, go through it step by step that she clearly violated. Anyways, though, with the initial coin offering, I think there's still a lot of potential there for volatility traders, for speculators. I'm not really, as you know, I had on Chris DeRose. I've gotten a lot of negative feedback from people who, on the interview, even though he's a very well-respected computer programmer, he's been writing Bitcoin articles on respected Bitcoin websites, and he has a popular Bitcoin Uncensored podcast. He's been doing these things for years. And he basically has a more balanced view on Bitcoin and these altcoins and these ICOs, just like you have a balanced view on gold and silver. And, people didn't want to hear it now. They want to be told basically their confirmation bias that I'm going to get rich off Ethereum. I'm going to get rich off these altcoins. I'm going to turn $600 off this ICO in 2 weeks into $12,000. They want to hear more people like experts like that instead. They don't want to hear the other side of the argument.
Well, that's human nature, and you see it, and there's a reason why my channel only has, besides me, only 2,000 subscribers. Is I don't have headlines that say this is the most important video you're ever going to watch. Prepare for what's coming. Collapse. Silver 600. Those are the types of things that people want to hear, and I think it gets to the point where not only do they want to hear it, that there's so many channels out there catering to that people will go from channel to channel, 7, 8, 10, 12 different channels, hearing a variation of the same story, so that they become convinced that that is the narrative, that's what's going to happen, that's what they want to believe. And when they hear something else, they, like you say, they get mad, they get furious. And that's just the way things are. People don't necessarily want to hear what they want to hear. And, that's entertainment. I understand that. But when you're investing, you need to know things that maybe you don't want to hear or don't want to know. But people view this as an emotional game, something that makes them feel good when they go to these channels and they get that type of information that's just, as you say, confirmation bias.
Yes, and there's profits to be made speculating on these altcoins, speculating on these ICOs. What is dangerous, though, Lewis, I'm not sure if you've heard the same stories from your listeners, is that I'm hearing people selling all their gold, selling all their silver, selling all their mining shares, selling other investments, and pushing all their chips into the front of the table, poker analogy, all in on Bitcoin, Ethereum, after these things have already gone up a lot. Here's the Wall Street Investment Bank setting higher price targets for these things. It's always a red flag when the Wall Street Investment Banks, after things have already, Ethereum has already gone up, over 30-fold in the last 4 or 5 months, and the Wall Street Investment Banks now are setting higher and higher price targets on these things.
Well, there is an argument that, and this is the balanced view, that cryptocurrencies still have a long way to go because they have a lot of momentum. They have a lot of people that are interested in them globally. There's a lot of work being done on the development side. There's just a large infrastructure and ecosystem building around these. So what you're probably going to see are winners and losers. I don't think the whole crypto scene is going to be a loser. I think you're going to have a lot of excesses and you're going to have a lot of losers. But overall, I think it's going to be similar to the internet. You will have, I think, cryptocurrencies in 10 or 20 years will have a much wider footprint, and there will be big winners in it. And there will also be ones that are like pets.com and CD Now, things that just go by the wayside. But that doesn't take away from what's happening. I really do think that cryptocurrencies, I wouldn't say are the future, but have a future because there is enough interest in them. And the reason I say that is not because it's my view that I like cryptocurrencies. I've learned over the last whatever number of years is my view on things doesn't matter. And what really matters is what a large portion, not even a majority of people are willing to view as value. And if there's enough people that view these things as valuable, see the value in them, treat them as valuable, they will be valuable. And, we see with gold, we see the same thinking on the gold and silver side, people insisting that only gold is money, only silver can operate as money, when that isn't true. That is their opinion. That's what they want to believe. Unfortunately, the biggest portion of people in the world, Jason, believe the dollar is valuable. And we all laugh at that because we're on the gold and silver side. Oh, it's toilet paper. Well, that's our opinion. The vast majority of the world views the dollar as valuable. So what we think about it really doesn't matter. And it's the same with cryptocurrencies. I look at them and I say, well, they're just invented out of thin air. They don't serve any purpose other than to transact, but you can transact with anything. So now you're into a philosophical reason, but then it doesn't matter. If enough people have bought into cryptocurrencies, they're going to be valuable, they're going to rise in price, and there's going to be a lot of money, time, and effort put into the whole space.
If you live in Venezuela right now, God forbid, or you live in Zimbabwe, I mean, a U.S. dollars are like gold to you.
Correct.
So So you may not have any gold or silver. It's probably difficult to find any in those countries right now. But you have dollars. I can guarantee you're trying to find dollars. You're trying to figure out a way to either buy more food for your family or get your family out of those countries.
And we look at it, Jason, and we say dollars are wrong. They print too many. We go into all the reasons the dollar's no good and the dollar collapsed.
Wow.
But that's our point of view. That isn't what how the world looks at it. Because if the world looked at it that way, gold would be $50,000, silver would be $20,000. All cryptocurrencies would be worth far more than they are right now. But that's not the case.
Well, one man's trash is another man's treasure, is the old cliche saying. But, with a currency and a government like Venezuela that's hyperinflated the Venezuelan bolivar, yeah, dollars are going to look good. They've been mining Bitcoin in certain areas. They've been starting to mine Bitcoin. So dollars, Bitcoin, gold, and silver, if you have a combination of these things, you're going to be able to maybe survive the hyperinflation or figure out a way to get your family out of those countries.
Mm-hmm.
Well, I want to transition now to another video that you recently did, and the alternative media isn't really covering this. I think you're the only one I've seen mention this. So you mentioned that now Saudi Arabia and China have started buying US Treasuries again. Why do you think they're doing that?
Well, and Russia too. Well, you could speculate on it, but one of the correlations, but perhaps not the causation, is the presidency of Donald Trump and also the decline in the dollar. So one of the things that I was saying 2 years ago, 3 years ago, when everyone was insisting the Fed can't raise rates, wouldn't raise rates, the next thing they're going to do is QE4, I was saying no, the Fed is going to raise interest rates, if for any other reason, but then to support the dollar. Because if the dollar is to be the world reserve currency, zero interest rates doesn't cut it. That's fine for every other country to have zero and negative rates, but the Fed needed to get off the dime and raise interest rates. And they did. And after the first, what everyone thought, that's it, it's one and done. And if they do it, the whole world is going to collapse. It didn't. And I said they'd raise them again when and as necessary. And they've been doing that. Now, when you raise interest rates, you put the treasuries on sale, so to speak. Right, because they pay interest, they're more attractive, the price, you're getting interest on them. And I think what's happened is a combination of things is in China, they had sold off to defend the yuan. They had sold $1 trillion worth of reserve assets, not just US Treasuries. And it's time to add back Treasuries. I also think that they didn't want to be labeled a currency manipulator as Donald Trump had suggested, and maybe they wanted to add a little Treasury securities, U.S. securities as insurance against that. I think Russia added back because they're trying to build up their overall reserves. And remember, the number one reserve asset is not gold. It is U.S. dollars. That's where the trade is. Petrodollar, for whatever reason. Also, the United States is becoming a major oil exporter. So you need dollars to trade with the United States to get that oil too, not just the Saudi oil. So people or countries are adding treasuries because they do need dollars. The days of the dollar collapse, yeah, maybe one day. But currently, the main countries today, Jason, that produce most of the world's trade are not along the Silk Road. They're Europe, Japan, United States. And to trade with those countries, you need dollars. Now, Saudi Arabia, you had mentioned an interesting point, was, maybe the U.S. shamed them into buying them. If you remember, before the 9/11 bill passed, Saudi Arabia actually went public and said, we're going to dump treasuries. You passed this bill against us, and we're going to dump treasuries. Okay? That was the bill passed at the end of September. Since November, they've added $40 billion of U.S. Treasuries. Now, some people say the U.S. shamed them into it, but also, remember, they did an arms deal too with them. So Saudi Arabia, they can threaten all they want, but now that the United States not only protects them, and that there's now competition in oil from Russia. Russia's a big oil producer, and it sells oil. They're also competing with the United States now for exports. So Saudi Arabia basically has one thing, oil, and the United States backing it, and oil prices are lower. So you're seeing Saudi Arabia adding to its U.S. Treasury position. So we saw Russia, China, Saudi Arabia, over the last 6 months since Trump was elected, increased their Treasury positions. The one country that is shedding its Treasury securities, and this could be because of Trump, is Mexico. Mexico has slashed more than half of their Treasury securities. I just did a report on this yesterday. Mexico is dumping U.S. Treasuries. They're now down to about 38, 39 billion in Treasuries. Now, if they dump Treasuries, even if Saudi Arabia dumped Treasuries, that market is so liquid. I mean, if Mexico were to get rid of all theirs tomorrow, Jason, that's like 1 month of QE. It's no big deal. So these threats, that the only country that could actually cause some damage would be if China, and that would be biting their nose to spite their face if they sold their $1.1 trillion worth of treasuries in one day. They wouldn't do that. That's not going to happen. And these other countries that threaten to dump their 30, 50, 70 million doesn't have any impact. In fact, Russia used to have about 160 billion in U.S. Treasuries. They did dump during the sanctions period about half of their securities. They were down to about 50, 60, 80 billion dollars worth, and they've since built their Treasury position back up. It is the world's largest and most liquid market.
I think, there's a number of different reasons. You outlined some of them why countries buy treasuries. I think a lot of it has to do with paying tribute to the U.S. empire. So either in Japan's case, the U.S. provides military protection for them. Western Europe, the U.S. was paying for all the NATO bills for their defense against the Soviet Union for so many years. Now Trump has said he wants to get them to pay for their own defense. So, they're going to buy treasuries to pay tribute for that, for the U.S. empire. That's part of it. The other thing is, in the system we have with the dollar standard that we have right now, other countries, want a trade advantage. So the best way to do that is for them to prop up the U.S. dollar, prop up U.S. treasuries, and they could do that by, buying treasuries and devaluing their own currency to try to get a trade advantage. So maybe, besides China not wanting to be labeled a currency manipulator, maybe they wanted to also appease Trump by the fact that, they were worried that Trump would start putting on trade tariffs on Chinese goods, VAT taxes and other things. So maybe behind the scenes there was negotiations. China said, well, what if we start buying treasuries again? Right. You're not gonna label us a currency manipulator. You're not gonna put these trade tariffs on.
Well, and the other thing you hit on a point when you were talking is the entire world has a vested interest, as you say, in propping up the dollar. Only somebody who's holding alternative currencies has an interest in the dollar collapsing. So that's what's the odd thing is China doesn't want the dollar to collapse one day. They would like the yuan to have a bigger and bigger role. But remember, if they want to become and stay a rich country, they need the United States and all those dollar-denominated assets also to be valued as they buy them, and then the yuan to take part of that stage. They don't. The idea, and I think it's just something that Goldbugs say, is China's going to crash the dollar. Well, that would be the stupidest thing they could do. It wouldn't make any sense for them to destroy their entire holdings and to destroy one of the largest trade partners, Europe, which is dollar-based, and the United States is their second largest trading partner. Why would they want to do that? What they want to do is gain greater control over the assets in the world, most of which are dollar denominated, and they want to buy gold mines and they want to buy real estate. They don't want those assets that they buy, not just the treasuries that they hold, to go down in value. See, that's something that I think that, again, it's that emotional trying to get people hyped up to buy gold. That China's out there trying to crash the dollar, and that China's out there buying gold hand over fist.
Well, I think China also long term wants to get out of its dollar holdings and be more diversified because
Absolutely.
they had way too much treasuries and not enough physical gold at one point. But they didn't want to do this overnight. They had so much reserve assets in U.S. dollars and treasuries that it's going to take them a long time to get out. And well, they've been doing this for a while now, buying foreign real estate.
But they don't want to get out of everything, though, Jason. They don't want to get totally out, as I say, because if they're totally out, then the value of everything that they've bought and everything they've held, they have to do it strategically and smartly, and it'll take decades.
Okay, well, in terms of the treasury market, it sounds like they're...
By the way, China also has tremendous amount of debt in their system. A lot of people think because China has gold that somehow they're immune to a debt crisis. The amounts of debt in the Chinese system are massive. They're basically following the United States to a T what the United States did. They built up their industry, they had trade surpluses, and then they decided, we can get more bang for the buck by leveraging that by issuing a lot of debt.
Yeah, China is very similar to how the U.S. was before the 1929 crash, okay? Because the U.S. was a creditor nation back then. They were producing a lot of the world's goods at that point. So, China's, they have a lot of non-performing loans in their state-owned banking system. They have a lot of municipal loan debt. There's a lot of debt problems in China, too, that only really hedge fund managers are talking about right now. But I want to ask you about this divergence. So, the last couple of minutes, we've talked about how there's demand for U.S. Treasuries, unlike a lot of the alternative media is claiming. But if there's such demand for U.S. Treasuries, then, in your opinion, why is the dollar index really since January of 2017, when all these hedge fund managers are going on business television saying they're long the dollar index? It was probably the most overcrowded trade. Everyone, once Trump won the election, almost every financial professional went long dollars. Why do you think the dollar index then is down more than 10% since January of 2017?
Because it got way, way ahead of itself. If you look at not just the last 6 months, and I think I've published this chart a lot, if you look at the dollar index today, it is higher than it was during during QE and before QE. So it's really at a 10-year high, and it was at a 15-year high just 6 months ago. It went straight up when QE ended on the understanding that the Fed was going to raise rates. They really weren't. They were going to raise rates, but they weren't going to normalize rates. They weren't going to take it to 3 or 4%, and that they were going to unwind the balance sheet. See, what the Fed did was, by doing QE in stages and not just announcing in 2008 that they were going to do 6 years worth of QE, $4.5 trillion, they never were going to stop, they were going to take interest rates down to zero, the dollar would have absolutely collapsed, but it didn't. But they managed to, every time the dollar index fell a lot, and they into like maybe 12 months of their QE program, they would stop and they would take a breather, and then the dollar index would move up, and then they'd start QE again. And when they finally stopped QE supposedly for good, QE3, the dollar index took off for 2.5 straight years, from the end of 2015 all the way to January 2017. And now it's come down 10% to 93. And I think this is why they'll continue to throw in these rate increases every now and then to kind of give some support to the dollar, because if they want to do QE4 again, they want to do another QE, they've got to have the dollar index up pretty high. And also, Europe is doing well, too. Remember, the dollar index, what people need to understand about the dollar index, it's the dollar versus mostly about 56-57% the euro, and then the yen, the British pound, and the Japanese.
It's not a basket of foreign currencies.
Correct.
It's just mostly the euro against the dollar against the euro and the yen and the dollar index. Yeah.
And the
British
pound
yeah.
and the Swedish krona.
Okay, so you mentioned that the Fed has been able to get away with this because they've done it in stages. Do you think also that they've been coordinating with the European Central Bank, with the Bank of Japan, with the Bank of England to coordinate exchange rates, to make sure that to talk about which banks in which countries are in trouble, because it seems that there's been a lot of weird games going on with. If you would have told me let me just say that if you would have told me after the 2008 financial crisis that the European Central Bank would have its balance sheet over 4.7 trillion, the Bank of Japan would have its balance sheet over 4.5 trillion, the Federal Reserve would have its balance sheet of 4.4 trillion, the People's Bank of China is going to have to do an enormous bailout, probably even larger than any of those in the near future, and yet, you know, the currency exchange rates are where they are, the stock market's up, the bond market's up, the real estate markets are in some cities in the United States are acting like the 2008 financial crisis never even happened. So do you think then there's just been an enormous con game or magic trick the central bankers have been able to get away with so far?
Well, they have to, they do, because they're all based on fiat. And this is the whole point you were making earlier. They have a vested interest in propping up the fiat system. So not just the dollar, but the whole system. So this idea of currency wars is nonsense. What they're doing is they're coordinating. If you think about when the United States ended QE, the Fed ended QE in 2005, the next day Japan launched theirs. Also, Stanley Fischer's big buddies of its mentoring Mario Draghi, he convinced Draghi to do QE, you know, wonderful thing. So once everyone does QE and everyone's doing QE and they're all doing negative interest rates and zero interest rates, well, in reference to each other, none of them are doing anything wrong, because if one of them does it, then it's an outlier and then that currency gets clobbered. But if they're all buying assets, see, the Fed looks prudent right now. The Fed never, at least officially, never went out and bought corporate bonds, never went out and bought equity securities like the Bank of Japan, like the Bank of Switzerland, never went to negative interest rates. So the dollar is now holding up, because it's the world reserve currency, holding up this whole fiat system because they look prudent. They're still reinvesting the $4.3 trillion worth of QE assets that they have, the Treasuries. And it's not, if taken on its own, the Fed is not a prudent entity. But because they've coordinated with all the other banks and convinced them to do QE, convinced them to buy assets, convinced them to take rates down to zero, then if they're all doing it and all the money in the world is fiat, then there's not a problem. And that's why they're afraid of Bitcoin and gold, because you can't do those types of shenanigans with most cryptocurrencies, and you certainly can't do it with gold other than on the paper side.
I think we're definitely going to have a financial crisis in the next 2 or 3 years, because, you know, they've done this coordination, and yet here we have all these different bubbles that have been formed in asset markets, in subprime auto loans, and in the derivatives market in China. So it just seems, Lewis, that the problem, nothing got solved after 2008, and they just either they created new asset bubbles or credit bubbles, or they reinflated old ones, and they're calling, you know, all these new bubbles or reinflated old ones a recovery when there was no real recovery after 2008.
They moved everything upstairs is what they did. They basically took all the problems and they brought them up to the central bank level. Remember, the financial crisis of 2008 wasn't a central bank issue. It was created by central banks, but the issue was in real life, that people couldn't pay their mortgages because of the higher rates, and then all the credit default swaps kicked in, and you had a cascading effect. The difference is when these large fiat issuers have issues, they just issue more currency and they can paper over it. They couldn't do that fast enough in the private industry. So what they're really trying to do is gain so much control over the economy so that they are the economy. When you have Swiss National Bank buying equity securities in the billions of dollars, and you have the Japanese central bank buying all of the newly issued
10-year,
yeah, exactly, the Japanese bonds, then they become almost immune, other than for inflation purposes. They backstop everything, and that's
they're hedge funds.
They're hedge funds. Yeah, absolutely. And that's what the Fed, the Bank of England, the Bank of Japan, the ECB have done, is they've not just intervened in the market, they've intervened in a huge way, that really on a scale that's never happened before. So when you say this time is different, it is, because the central banks are not just the size of the Greenspan put in '87 has grown exponentially. That was just, you know, the market went down, the Fed was going to pump some money into the markets at the time. But today, they're in there the Swiss National Bank files a quarterly report, the SEC, on how much, how many, the dollar value of the U.S. equities that it buys every month, that every quarter. That's crazy. And the Japanese, they do the same thing in Japan. And Janet Yellen mentioned in one of her speeches about 6 months ago that we need to consider doing the same during the next recession. Meaning she wants to go shuffling back to Congress and say, hey, our mandate doesn't allow us to buy U.S. equities or corporate bonds, but we think we can end this recession. We think we can end the stock market crash if you just let us do it. And I could see Congress saying, well, that's better than printing money and buying worthless mortgage-backed securities. Sure, go out and buy some Apple. Go out and build that confidence back up. That's the real danger, is that the mentality of people is that central banks, they forget that they get you into the problem, but they figure, well, if you just give them more power, they can fix it.
Or they don't care that it'll be someone else's problem, 4, 8, 12 years from now. That, they've, because I think Janet Yellen and Mario Draghi are both going to be long gone before the next crisis.
Oh, well, you know what she said? The famous line was, I don't think we're going to have a financial crisis in our lifetime. Yeah, maybe not yours, but the rest of us maybe,
Yeah, so in 2008, that was an interesting point you brought up. There was not, it wasn't a sovereign debt crisis at the time. It was a real estate crisis, mortgage-backed securities. People were not able to, they were getting their homes foreclosed on. They had overborrowed, they couldn't pay, etc. And the banks were the ones, the large banks had way over-leveraged themselves. And, the central banks had helped, they were the majority problems with allowing the banks to get away with these leverage levels. But, there wasn't sovereign debt crisis. There wasn't, are these central banks all, grossly insolvent? Their balance sheets hadn't exploded to enormous levels like they are now about 10 years later. So, now the next crisis, Lewis, I think we've set up, we have these sovereigns with the help of the central banks, these governments now that have, drastically over-indebted themselves since 2008 to buy more time. And then, even with these high asset prices, we have a huge pension fund crisis in spite of all that.
Well, the pension fund crisis is different because they're relying on what they take largely from, that's the Ponzi scheme aspect of it. They can't get more money out of the workers to make the assets in the retirement scheme worth more. So all they can do is hope that asset prices rise. They're trying to grow out of it when they're underfunded for a reason. They overpromised how much they were going to pay these people, and there's just no way they can meet those obligations.
Yep.
Because what happens is they, with the teachers union, whatever unit it is, they promise them a certain amount. They say they're going to cover it, but they don't have the money to cover it because then they'd have to raise property taxes beyond the amount. So they just figure they'll promise it and figure out in 20 years how we'll get to that number. And they rarely ask the teachers or the workers to put in more to cover it. So it becomes a Ponzi scheme. And also, people go along with that because the taxpayer realizes, oh, well, you didn't really give in and give them a raise. You just raised their pension, so that doesn't cost me anything. Well, of course it does, because I got to pay it.
Plus, if you're a politician and you're trying to win either an election or re-election, and you're promising like certain teachers unions or CalPERS or CalFERS or those guys, you're trying to get their votes, and you're promising them, a good retirement, they're going to vote for you.
Absolutely.
So, yeah, the math doesn't work. Yeah, they need to put more money in, or the assumptions for the types of returns that the pension fund needs to get for them to have that retirement are totally unrealistic. But who cares about that? Because as long as I win the election, I'm going to get rich, in Congress. I'm going to make the connections and, with the special interest groups and the lobbyists, etc. So that's the system, the incestuous system, of parasitical short-term rent-seeking that we have right now.
Absolutely.
Yeah, so I mean, eventually, the other thing, I actually just heard this. I was watching a month-old presentation on Real Vision TV, and what these pension funds are doing to try to make a little extra money, they're picking up, quarters off the freeway during rush hour traffic. They are selling short straddles. They're betting against volatility on, you know, the VIX and a lot of these others, they've been collecting billions of dollars in premium. So there's all these, you know, pension fund managers and hedge funds that pension funds hired to manage their capital. And so to collect extra premiums, they've been doing this for a couple years now, betting that the central banks have their backs with no asset price volatility. So they've been collecting premium, you know, loading the things up with, they've been using leverage. So not only have they been, you know, selling normal short straddles, betting against volatility, they've been doing it with leverage. So this thing's going to blow up in a couple years too, and magnify the volatility we're going to have in asset prices as well.
And you know, when you think about pensions and banks, when I was a kid, the idea of money in the bank was a sound thing. The idea of your pension was rock solid. Now they're not.
Well, that was defined benefit, though. So that defined benefit was, you know, if you worked for many years ago, if you worked for the company for 15 or 20 years or longer, you got a really nice pension when you retired. Maybe you got 80% of your salary or whatever, right. And then you got a nice gold watch and you got other perks, stock options or things like that. Companies, for the most part, have totally gotten rid of that.
You know why? I mean, because they realized that they can't afford it, but that didn't sink in with the public sector jobs. They still offered those pensions knowing that they couldn't, and never phased them out, that they couldn't pay them.
Yeah, and the only other people that get those kind of golden parachutes now are like the executives of publicly traded companies. So, but they're trying to cheat to get like the earnings targets up per quarter, and so they're, you know, negotiating with Wall Street analysts to lower the revenue and earnings bars so they can beat them and trigger their stock options packages. But, you know, anyway, that's the time for another discussion. I want to ask you now. So your opinion on gold and silver. We were talking about this last week about the gold and silver markets. In your opinion, would you characterize U.S. retail investor demand for gold and silver? Would you say it's collapsed then in the last couple of years?
Gold only in the last. I mean, I track monthly the U.S. Mint, Perth Mint, quarterly the Canadian Mint. The U.S. Mint sold through June of 2016 was on record pace, and then it kind of fell off a bit, the silver demand, and then earlier this year it opened up strong. There was about over 5 million silver eagles sold, and then it fell off for a few months. But last month, just the month that just ended in July, was 2.2 million, 2.3 million silver eagles sold. Not a horrendous amount, but not a earth-shattering amount. What's fallen off the table the last 5-6 months is gold sales. They're at very low rates, but that is in contrast. I mean, remember, before I mentioned China and India, which are the gold demand in China and India is massive right now. But the U.S. gold sales and the U.S. silver sales were never on a global amounted to very much. So the United States may sell in a given year all gold eagles, 1/10, 1/4, 1/2, 1 ounce, and then the American gold buffaloes, maybe 1 million ounces a year. I think the best year they ever did was 99 in 2000. They sold 1.5 million ounces. That's really nothing. The silver eagle sales are pretty substantial when they hit 47 million in 2015. Now that almost was like 5-6% of the overall global silver mining production. That has faded a bit. Last year was 37 million. This year to date, we're only at about 14 million. So we'll probably sell 20 million American silver eagles this year. So you can't really even say that silver demand and gold demand at the U.S. retail level has any impact whatsoever on the physical supply demand dynamic. And the physical supply demand dynamic really doesn't have much of a influence on price. But what's happening in India and China is quite spectacular, because the well, let me give you the first half of 2017. This is not the People's Bank of China. This is just the private citizens. Bar demand was 4.9 million ounces. Jewelry was 10.6 million ounces. There was a total of, just the first half of the year in China, over 17.5 million ounces. So that means that's 35 million ounces. Remember what I said about the United States selling 1.5 million American gold eagles, ounces of American gold eagles. That's 35 times the amount that the United States basically sold last year was about 1.2 million ounces. So Chinese gold demand is massive. Indian gold demand also massive, even though the government tries to tax it when it comes in the country, when they try to sell it. So the demand for physical gold and silver in China and India is huge. But we haven't seen, this is what's stunning to me, is this amount of demand didn't exist 10 years ago, 20 years ago. And, the price hasn't really reflected that much of an increase based on the massive amount of physical demand we've had, not from the United States, but globally. And then tie that into what you're always talking about is the mining production, and then the future reserves aren't really there to meet this demand the way the demand side has been exploding, and then the mining has been so-so. And the only reason they've been able to meet the demand is because, as you say, they high grade the mines, and they cut back on expenses, and they're not doing the research, the exploration that they need to do. So I think, at some point we will have a physical perhaps shortage if this dynamic continues, where they can't convince Indians and Chinese to buy paper products, because gold demand is easily settled in the United States at the hedge fund manager level with ETFs and COMEX contracts. When they say they're buying gold, they're not buying gold, they're buying an ETF. And as you know,
GLD, yeah.
Or GLD. They're buying GLD, or they're buying futures. So the problem with gold is you can satisfy the financial demand with dollars or other fiat. Silver's a little more difficult on the on the industry side, because about 50% is industry, and you can't put a silver ETF share into a solar panel. You can't run electronics on a COMEX contract. But so far, there doesn't seem to be any hint of a shortage where manufacturers have to go and pay a premium to get their metal.
Yeah, I think the manufacturers are starting to look at maybe deals with the individual miner then for doré bars and refining it themselves, but then that doesn't affect the price. So I've heard stories of that so far, but it hasn't really affected the price. But, this whole thing is definitely unsustainable, because at some point the miners have cut a lot of costs the last few years. We've had a paper bear market in gold and silver since 2011. So initially the miners were not able to cut costs fast enough. They were in jeopardy of going bankrupt very, very quickly. The last couple of years they've been better at cutting costs. They've been, working their butts off to survive and cut costs. And some of them are doing okay now. But, in the short term, they can tread water and survive. In the long term, this is still a mess for gold and silver, although silver is even worse than it is for gold. A lot of the primary silver miners, Lewis, that have produced a lot of ounces of silver production over the years, they're getting out of the silver business. Mm-hmm. So Silver Wheaton doesn't mine silver, but they do silver deals on either primary silver stream miner silver streams or silver byproduct streams. They can't find silver deals right now. So and the majority of their revenues now are in gold. So Silver Wheaton is now Wheaton Precious Metals. Silver Standard is diversifying out of their silver mines. They bought a couple gold mines, I believe, and so they have a large portion of their revenue in gold production. You have Hecla and Coeur d'Alene Mining, which are both, longtime senior silver producers, producing a good amount of ounces, about 30 million ounces approximately a year between them. And, they've been buying gold mines the last couple years, and with Hecla, a large chunk of their revenues is in base metals. So this, to me, when I look at that, it looks to me like, a lot of companies have just figured, we see the writing on the wall. We can't really make that. There are no more, there's not a lot of primary silver mines available that are high grade, low cost anymore. There's a couple like Mag Silver, and they're a special junior, but almost all the other projects are all, either lower grade and or much higher cost. And those things aren't going to get anyone who tries to build a mine in this environment for one of those is going to go bankrupt. So, I guess everyone's just trying to tread water, and I think they're overstating their free cash flow, and a lot of them, because they're using non-GAAP, And I think they're slightly understating their costs with the all-in sustaining cost measure. I got in an argument with one of my listeners. I had to block this guy because he's been posting on almost every single video now for weeks, claiming that primary silver miners produce silver for $6 or $7 an ounce. I don't think he can read any financial statements. I don't think he understands how the mining business works. He didn't look through any investor presentations. I did a short video showing exactly what the costs are and showing how they weren't even in compliance with GAAP.
Well, I sent you one today that we had never heard of, and they were bragging that they had gotten their cost down to $13.76. That's no, you know.
Well, that's not
$6 or $7. That's still,
yeah.
You know.
Well, that's a pretty low cost producer. I mean, that's maybe a little bit higher than First Majestic Silver. But, you know, some of these miners in other countries like Peru and Mexico, they if their currencies fall against the dollar, they have some advantages to cut their costs a lot faster than some of the other producers in either U.S. or Canada or more established countries.
And lower oil prices have helped. But you know what? The one thing they're counting on is, I don't know if you've seen the chart I've done, from 2006 to 2016, the percentage of investment demand for gold, silver coins and bars and rounds went from just 5% to about 22 to 25%. And that's unsustainable if you also have industry. But what's happening is, I think, because there is, like you mentioned at the top of this show, people moving their money out of physical metals and maybe not just into ETFs, but also into cryptocurrencies. If they could keep if they can, and they seem to have stopped that massive physical demand for coins, rounds, and bars, if they keep that low, industrial demand, while the overall demand in terms of the uses of silver is higher, the amount of silver required is lower, because electronics, while we make more electronics, we make them smaller, it uses less silver. And I think 10 years ago, we used 300 million ounces of silver in a year for electronics, and last year they was 226 million, even though there's more electronics now than there was 10 years ago. Same with solar. That's a big industry. It's getting bigger, but they're finding out ways either to substitute the silver, but more to use less silver in the panels. And then, of course, if silver really does get rare and there's a problem, they can always switch to graphene and put that in the electronics. So it always seems to be some way out of it.
Okay, so long term, I think graphene has a lot of potential, but there's huge manufacturing problems still with graphene. There's been in the last 12 months, there's been a couple manufacturing processes that may work to ramp up low-cost manufacturing of graphene, but none of it is scalable yet.
And there's no reason to do it when silver is $15, $16, $17 an ounce.
Well, graphene is stronger than steel. So for certain things, there would be incentive to do it. They just can't do it yet.
Well, also when you change your there's a cost to switching over and so on. But my point is that if there's less demand, even putting aside graphene, less demand for silver on industry, and they cut the investor demand down, then they can put up with lower output on the mines.
I guess they could do that, but the miners, I think, are basically out of ways to cut. I mean, that you were talking about how I think that silver miner sent me the article had been able to cut costs 8% per year for the last couple of years.
Well,
that's not
sustainable. No, what I meant was not that they can continue to cut, was that they will indeed have probably less production over the next decade. But I'm saying is there may be less demand also for the silver in electronics, in solar panels, and in the form of silver eagles and things and coins and bars, if indeed people are buying the paper silver, or they're moving a lot of that into the cryptos. You know, you talked about people selling all their gold and silver and buying cryptos. Yeah. That's maybe somewhat of a trend. I'm not saying everyone's going to do that, but you only have to take 10, 15% of that demand away, and that cuts into the physical demand for physical gold and silver.
Yeah, it's tough to measure exactly how many people have sold their gold, silver, mining shares,
or how many will.
Yeah, and put it in and put all that capital into cryptos. I mean, it's anecdotal evidence that we have. I have a large podcast that's anecdotal evidence now. With that, but I mean, you know, if we did get to silver had broken 16, and it looked like, I think there was a flash crash on silver, and it temporarily I think dropped below 15. If it had stayed at $15 an ounce or gone below those levels, you were looking at at least 30 million, according to my research, at least 30 million ounces a year of primary silver miner production, not even counting the byproduct guys. With base metal prices, maybe we had a manipulated base metals rally there to help the silver byproduct. Maybe that was some manipulation by the bankers there to make sure the silver byproduct production didn't fall off either.
Right, copper is up huge, and also if you mentioned if the price had fallen, not only would you have the fall off in supply, you would have had a massive increase in physical demand because a lot of people would have jumped off and bought the physical silver eagles and things and gold, silver coins, rounds, and bars around the world.
Oh yeah, at $15 silver or below, I mean that was a bargain because it is a no-brainer that that long term that you were going to make out if you were just going to trade those metals, not if you were a stacker necessarily, but if you were just going to make a trade for 2 or 3 years, that you were going to do well on that if you could have gotten silver at $15 an ounce or less.
Oh sure.
At this stage, I mean the mining industry has figured out ways to bring on marginal high grade ounces to increase the silver. But if you go back and look from the silver production 10 or 15 years ago, people ask me, Jason, why can't the miners produce silver at $4 an ounce like they could and make a profit 10 or 15 years ago? The answer is the ore grades are not there. There's a lot of other input costs. The cost to build the mines are much higher. So in order to have increased that silver production to the levels we have now, a lot of things went into to bring on that extra production, and normally it meant higher cost, lower grade silver. So, and the miners they're kind of treading water temporarily, but like you said, long term, the exploration, there was a good amount of exploration drilling last year when it looked like the bull market had restarted. There was a good amount of exploration capital that went into the ground. There was some mergers and acquisitions, but that has slowed down a lot.
Yeah, the first half of the year, 2016, looked like it was finally over. And the prices were just going to go on a steady increase. And then it got capped at the end of the year. And we haven't really seen a rally. Although the beginning of this year, there was a rally, and it lasted till about May. And then it got capped again.
Yeah, but I've said this now for a while, but just from a supply perspective, to replace mined reserves so the industry can make a decent margin and replace because the industry, to keep production levels, they haven't cut as you've pointed out, Lewis, with your articles and analysis, the industry hasn't drastically cut gold or silver production yet. So they've been still running the mines probably to pay off debt, or they need the cash flow even if it's break even at a loss, but they have hurt their reserves.
Absolutely.
So they are not. Yes, so they are keeping production levels around the same, but they have not replaced reserves, and you can't do that at current metals prices. You don't have the free cash flow to reinvest in either mergers and acquisitions, going out and buying a new mine, or spending on an exploration budget. You don't do that. So, the industry, from a perspective of looking at potential new silver mines, the silver industry is going to need $25 to $30 an ounce silver in the next couple years, and the gold industry is going to have to have $1,400 to $1,500 an ounce gold. These are going to be minimum price floors in the next couple years if the supply levels are going to either stay at the current levels, Lewis, or increase. But like you said, maybe the manipulators with the paper price manipulation, if they can drop demand for physical, then the miners then don't need to bring on either keep the supply level, production levels the same, or increase supply.
What is fascinating is how they managed to keep this thing in a range and an equilibrium. And I think one of the attractions of the cryptocurrencies are you do see explosive, uncapped movements to the upside. And that does attract people. You do your research, you think it's a good buy, gold or silver, it doesn't go anywhere, and then you don't have to do any research. You just pick a hot crypto and it goes flying. It's hard to stay rational when being rational makes you lose money, or at least doesn't make you any money.
Yeah, and then you have your friends or your with cryptos. I've met a lot of people online that are getting rich off those.
And some of them who you might think are complete idiots. No, I'm serious. Not that investing in crypto means you're an idiot, but what I'm saying is that it's just like .com investing. You didn't have to have any economic
good point.
You just kind of get on the right one.
That's an excellent point. I remember hearing that, while everyone was getting rich off the tech bubble riding it up, there was tons of people going on financial media and writing articles about how much of a moron Warren Buffett was, that he had lost his magic touch. And, so many very astute, financially savvy people wouldn't touch the tech stocks.
Well, what it was his famous line was, "When the tide goes out, you see you swim without trunks." That was, but you don't know that until the crash.
Yeah, so it's going to be a very interesting. It's going to be a very interesting next couple years. With President Trump, he always keeps things interesting because every day he's putting out he's making a spectacle of the mainstream media with social media. He's in a constant fight with them, and the drama. This Scaramucci guy. I mean, just in 10 days. I mean, look at all the crazy stuff that is out.
That one comment he made, which we can't repeat on this channel because you'll get a content violation strike, was unbelievable. The thing he said about Bannon.
Do you think then now we're going to wrap up the show here because we've been over an hour, and Louis, you and me are good friends, so we could talk for a while, but do you think then that basically Trump has unknowingly set himself up to be like the bag holder then for taking credit for the stock market rally? And the central bankers are now basically, Stanley Fischer just gave a speech, I guess this week or last week, and he said that the reason we're not raising rates more is they admitted the global economy is not doing well, the U.S. economy is not doing well, which is the exact opposite of the stuff that Trump and the other people on financial media are saying.
Okay, so my original thought on Trump was he ran on this. I'm an outsider, which he really isn't, but he ran on the concept that he was the outsider. And if you think about who his political enemies are, they are all the establishment, mainstream media, people who go to Starbucks, people who invest in the stock market. Remember, he's a real estate guy. My original thought was that, and he said that we're in a big bubble. Once he became president, he said, "Oh, this is great. Stock market's going higher because of me." And now, of course, he owns it. He's got his name on it. He's been bragging that, just like Obama did, that the stock market is the economy. The stock market is up. Therefore, I'm a good president. Trump is doing the same thing. Stock market's even higher. I'm an even better president. I think, however, when the stock market collapses, he's going to disavow it. And then he's going to say, "Look what all I've done on bringing jobs back, industry," and he's just going to pretend like he had nothing to do with it. And I think he's always done that. It's never his fault. And I think he's going to take credit for it when it goes up, and when it collapses, he's going to try to convince everybody, like he did when he was on the campaign trail in 2016, that the stock market isn't the real economy.
I would like to see him try to blame someone else after taking credit for it, because, I mean, there's video evidence now and Twitter evidence of him taking credit for the stuff.
That's what politicians do. "I never said that. Depends on what your definition of is." I mean, that's what. Look, these guys lie constantly, and they get away with it.
Yeah, it's just funny. I think he's stupid for taking credit for it, but it's an ego boost to him.
Yep.
It's the main reason the stock market is up, in my opinion, is you have share buybacks with debt, which have slowed down a lot, but that's boosted stocks a lot. You have people with financial repression, desperate chasing for yield. You have central bank balance sheets exploding since the 2008 financial crisis, and a lot of that money leaked into the major asset classes. You have devalued currencies from all the major ones, the ECB, Bank of Japan, US. That money has to go somewhere. Then you have flight capital coming into the US. So those, a lot of flight capital that's left China. A lot of money has left China to go into other markets, either in real estate or stocks. I think even from a hedge fund presentation, a lot of money has left Japan to go in, because a lot of the printed money that the Bank of Japan had, yes, they've been buying up Japanese government bonds like crazy. Yes, they've been buying up ETFs in their stock market. They're a large owner, but a lot of money has also left Japan with the yen carry trade and gone into asset markets in the United States. So it'll be a very, we're gonna have to continue this conversation next couple months for our listeners. But I always enjoy my time speaking with you, Louis. Please tell our listeners more about the Smaulgld website and your channel.
Well, thank you very much for having me on, Jason. Smaulgld.com is the website. There's something up there just about every day. I cover gold, silver, cryptocurrencies, and real estate. And then there's as Jason mentioned, a YouTube channel with over 2,000 subscribers, and then I'm also on Twitter. So just look up Smaulgld and you should be able to find my work. Thank you very much.
Wall Street for Main Street needs your help. YouTube stole $7,200 from Wall Street for Main Street in annualized YouTube AdWords revenues, and they kneecapped our analytics down by more than 80% across the board since September 2016 with their new censorship algorithms to stop the rapid growth of our channel. That was money we could have used to upgrade our website, pay bills, and invest in improving our content and growing our business. Our audience of loyal listeners is all over the globe and so large now that if most or all of our listeners were to commit to donating $1 to $5 each month to our Patreon account, we could easily meet our goal on Patreon. Wall Street for Main Street also accepts one-time donations on our main wallstreetformainstreet.com website. That's WALLSTFORMAINST.com website via PayPal, Gold Money, or Bitcoin. We also accept donations of physical precious metals that can be mailed to us. Thanks to all listeners who have already made a donation, and thanks in advance to any listeners who make a future donation or contribution to the growth, improvement, and success of Wall Street for Main Street.